Hi everybody, welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode 142, we're going to explore what could be a new concept and a new frontier, and that's fiduciary duties, which relate to establishing basis for income tax purposes. So we're going to really kind of dive into the more theoretical issue of this potential duty and how that could create issues in the future, and hopefully not necessarily open up a new realm of fiduciary duty, but instead serve as a warning that for somebody who is truly ambitious, who really wanted to sue a personal representative or trustee, this would be a route they could take. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, what is basis? We won't get into a deep discussion, but basis is an income tax measure of your unrecovered investment in a property. The intent is that if you sell a property, you're not taxed on the return of your investment. That's the return of your basis. Instead, you're only taxed on any growth in the value of that property over and above that basis. Now, in estate planning, when you receive a gift, typically you as the donee will have the same basis in the gifted property as the donor had. That's called a carried over basis or a transferred basis. And that amount could be increased where gift tax is paid out of pocket, or could even be decreased where the fair market value is less than the basis on the date of the gift. Now, for inherited property, generally there's a step up in basis to estate tax value, or maybe even a step down in basis. So that adjustment would be to the fair market value at date of death generally, but if a 706 is filed, that basis could be reduced by the amounts of discounts and potentially any reduction if you use the alternate valuation date in a taxable estate. So, one challenge with all of this, especially for gifted property and property received from a decedent's estate, is the question of what is the basis? Do you have enough info to establish that amount? Now, back in episode 140, I diverted from the technical discussion and told a heartfelt story about an annual exclusion gift I received, and that gift consisted of in-kind securities. But a lot of what led to my interest in estate planning before I even considered law school was the wild goose chase I had to go on to determine the basis of those gifted shares when I later sold some of them and had to fill out my own income tax return. So I had nothing to go on at the time, and ultimately it ended up being of no consequence because I was in the zero capital gain rate bracket and didn't owe anything because I was in college at the time. But in the case of donees, they may not always be so lucky. So, we're going to really kind of dig into whether or not there's a duty to establish a basis, whether it's on the part of the donor or the part of a fiduciary who controls the property or receives it. Now, right now, the IRS only requires two definitive sources of basis in the estate planning world. One is on the gift tax return, where there's a column to list the donor's adjusted basis on Form 709. In the case of an estate tax return, too, that can establish a basis, and that return may be required sometimes or may be elective. But if it's required to be filed, you also have to include Form 8971, which establishes basis under the newly enacted basis consistency rules under Code Section 1014F. Now, even if you don't have to file 8971, you could have an elective 706, such as a portability return or a return to make a Q-tip election, which sometimes could serve as a definitive source of basis, but other times may just have lower substantiation requirements and may allow for an estimation of value in increments of $250,000. And in that case, the return is going to be worthless for establishing basis. Now, for many gifts, especially annual exclusion gifts, no gift tax return is required, and that means no adjusted basis information from that 709. And for estates below the 706 filing threshold, especially if there's no elective 706, the heirs who receive that property end up being completely dependent on the personal representative to come up with stepped-up basis values. So we're going to kind of look at first individuals who receive a gift, and they may be out of luck. For individuals who do receive non-cash gifts, it's important to make sure as part of that you receive basis info as a condition to receiving that gift. And if that basis info can't be substantiated, then the worst case is that the IRS deems you to have a zero basis. And if you can't find this info by the filing deadline, you may be able to amend your return after the fact and claim a refund if you're stuck with a zero basis, but the clock's ticking. Once you file, you have 3 years to track down that information and claim a refund. Now, in the case of estates and trust, there's no express duty right now that says you have to establish a basis if you're a trustee of a trust or a personal representative of an estate, but this could become a bigger deal in the future. As I mentioned, there's nothing that really kind of gives me that hint, but I could see this being a new frontier. For one, if you're the trustee of an irrevocable trust, you have the authority to accept or reject property being transferred to that trust. So, as a condition to accepting that property, should you require accurate basis information? Maybe if you're a personal representative, you may just have to establish estimated estate values in preparing a probate inventory, depending on which state you're in. You may just be able to ballpark things. But the question is, should you get formal appraisals for illiquid assets and get the estate tax value for investment portfolios, even when no estate tax return is filed? Should you go through the process of getting formal valuations for the benefit of the heirs and beneficiaries? And finally, if you're a trustee administering a trust, maybe you make distributions that have a 643 election that establishes a deemed sale, or you're making a distribution that might be subject to GST tax that could be increasing the basis. So in that case, do you have a duty to establish a new basis and report that info to the recipients of the property? So while there's no express duty here, there could be a bigger deal in the future about whether fiduciaries have to establish basis. Now, it's important to note that fiduciaries already have informational duties. They have a duty to prepare accountings and inventories, which generally are good for establishing the fair market value of property because that's a natural component of an inventory. But what we could see in the future is that basis could become another component. So if anybody wanted to be truly snarky and go after a fiduciary, they could challenge the fiduciary's lack of action in establishing basis, maybe under the theory of they have a duty to prepare accurate accountings and inventories, and the lack of basis information could deem this inaccurate. Now, as a beneficiary, when we look at this duty, could a beneficiary also have a duty, or a right maybe, to challenge a basis that's been established by a fiduciary? And the ultimate issue here is that the beneficiary doesn't have a unilateral right to really go establish that basis in an estate planning context. They have to deal with somebody in the middle. For example, with an 8971, there's a personal representative who prepares that and distributes it, so the beneficiary would have to request first that the personal representative amend that 8971, and if the personal representative refuses to, the beneficiary may end up filing an income tax return with an inconsistent basis, and in that case, might be a good idea for the beneficiary to file a protective form 8275 or 8275R, which allows you to reconcile inconsistencies either in numbers or even in regulations if you disregard information or regulations that the IRS already has at its disposal or that Treasury has established. And by doing that, you could potentially mitigate penalties, especially for the tax preparer. Same thing might apply to a gift. The 709 might have to be amended by the donor if the adjusted basis info just seems wrong, or if the beneficiary wants to challenge that. And if the donor is not willing to amend that return, it leaves the beneficiary once again with really no unilateral right of action, and instead it leaves the beneficiary in a situation where they have to file an inconsistent basis return and maybe deal with the IRS. So it has to be a big enough deal to make that a route that the beneficiary might want to go. So that might only be a good idea in the case of sales of very high value assets. Now, if you inherit property that was reported on an estate tax return, one thing we discussed in the past is the remedy of equitable recoupment. And that applies if you're an heir who inherits property, then you sell it and incur a gain, but later the IRS comes back and examines the estate tax return and increases the value on that estate tax return. So the result is that that increase in value on the estate tax return would ultimately increase the basis that you should have had at the time of sale, which would lower the income tax of you as the seller due to a decreased gain, or even increase the loss that you could have deducted due to that increase in basis as well. So with the right of equitable recoupment, that could give you a longer runway than 3 years, especially if the IRS looks back maybe to a previous portability return at second death within a married couple. But in situations where there's no 706 filed or 706 required, you don't have this remedy. You're still stuck with that 3-year time period. So in any case, long story short, if you're a beneficiary, I'd say if you're selling property that you've inherited or received by gift, be very intentional about planning in advance to establish basis. And if you're a fiduciary, I'd say be very cognizant of the fact that your duties could include the establishment of basis for the benefit of a trust or for heirs and beneficiaries. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.